Welcome back to another weekly review. Quint, it's been an interesting week. I know this week's newsletter that we're writing is not exactly market focused, so we wanted to come on, put a video together, and talk a little bit about what's going on in the world, what's going on in the markets. The big news this week was inflation data, that we got a couple different things. And then also looking forward, we have the Fed next week, so tell us more.
So this week, CPI came out that was in line as expected, and that sort of gave folks a little bit of a sigh of relief because we had a hotter than anticipated CPI, a month ago. And so this was like, okay, we're kind of back to normal here. And then yesterday, we had the producer price index. That's more on the business side of things. And that was a little bit hotter than anticipated. So it does show that inflation is pretty sticky right now in some of these metrics. That's causing a bit of a pause in the market. It's much needed.
Yeah, absolutely.
That we did write about that. If you haven't had a chance to read that, please do. Markets have had an incredible start to the year. In fact, they've been on an unbelievable tear since October of 2023, and so we've carried that over through this year. We are in dire need of a pause. In fact, a pause that sort of digests gains is healthy. And then in certain areas, it might get a little scary, but that tends to kind of, digest gains, keep people a little on edge, and not, get the euphoria that tends to lead to bubbles, that tends to lead to, dramatic declines. So pauses and pullbacks are to be expected. That's what we're seeing in the tape now, and we're perfectly fine with that.
Yeah, so I feel like the news has not been as active. I mean, there's no earnings reports coming out over the last couple of weeks. It's really slowed down a lot, but we have the Fed next week. So what are you looking at in the news, and what headlines are you looking at?
Yeah, I'd be very interested to see what the Fed has to say. Jerome and company is really in a predicament here, Logan, because there is two different economies that are transpiring right now. There is the private sector businesses that are laying off people. They're seeing consumer demand slow, unless, of course, if they're in the AI business, they're seeing their business boom. But they're struggling with higher interest rates if they have debt. They're really facing a slowdown in the economy. In the public sector, however, in the government and healthcare and education, they're booming. And if you have a company that may be slowing, let's say they do both sides of business, they do private and public, the money that's been coming in for the infrastructure bill, the semiconductor bill, et cetera, is still flowing into the system.
Kind of like construction, right? Like construction, maybe not building private homes or private businesses or whatever it is, but now they're doing infrastructure bill and things
bridges
like that.
And roads.
Yeah.
That's exactly right. So when you look at the data doesn't necessarily carve out, the private sector is struggling and the public sector is great. But we all know that money, by the way, that we borrowed to fund these projects, it's limited. It's not forever. It's not forever money. And so the money is coming into these projects. It's making the economic data look sticky and firm. Meanwhile, there is erosion going on in the private sector, and jobs are being lost, unemployment's ticking up, consumer credit is increasing, et cetera. So it's so fascinating because here's what Jerome Powell doesn't want to do. If you think of the government spending for these projects like a faucet, when it's done, they'll turn it off. It's not like private increase and decrease or a cyclical economy where it starts to slow, increases, starts to slow. Money for a project's there, and when it's gone, it's gone. So he knows this, and the Fed knows this. So they're in a predicament because they're trying to see the inflation data come down so that they can feel confident. They said it doesn't have to be at 2%, but they can feel confident that they'll be getting to 2%. At which point they'll try to reduce rates to revive this private sector. The problem is the public sector and the spending holding it all up.
Yeah.
In fact, it's still inflationary. They have a tough situation on their hands right now. Our camp continues to be markets have been strong. We're digesting these gains. We could pull in a little bit. That's no problem.
Yeah.
We have folks that have come over. They still have cash on the sides. We'll be investing that. We'll be putting that money to work. We're perfectly fine with our allocation. And we ultimately believe the Fed will lower rates later this year. Probably May or June is the first time. They'll lower rates. And all the companies that are interest rate sensitive, small caps, emerging markets, industrials, et cetera, will do very, very well. So we're overall bullish, but we're bullish in the face of an economy that is slowing. Make no mistake about that. It's very difficult to decipher the two, but the stock market and the economy are two totally different things, at least in the short and intermediate term.
Great. I think that's a great summary, and we'll pretty much wrap it up there. But remember, next week when the Fed comes out, we are expecting them not to do anything, not to raise rates, not to lower rates. So if it comes out and that's true and they don't do anything, that's not the surprise. The surprise, or what the market's going to be watching, is that press conference that comes after.
That's what they say.
Obviously, we'll come out and talk more about that next week whenever we do another video. Make it a great week.